Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio, starting a fresh new week, Monday morning, 8 a.m. I'm Prashant. With me, as always, my colleagues Sonia and Nigel. Morning, guys.
Hi, good morning, Prashant. Morning, Nigel. Well, a start of a brand new week, but there are still some roadblocks, some hurdles that, the street has to sort of reckon with before those all-time highs come through. It's been a bit of a waiting game, I guess.
I want to start with what happened last Friday evening, when I don't think any of us was in office, but the team was, and what a Friday it turned out to be, right? One after the other. I mean, it just was
with the
flurry of
2,000 rupee
announcements.
note.
Yeah, the 2,000 rupee note, the clarification on the TCS. I mean, so a lot of stuff. And I think that 2,000 rupee note is something which we will take forward in discussions today in terms of the impact, etc. But I just want to quickly start with, just a few things that we always get to you, what you need to know as we begin another session. And I want to divide this into three parts. One is the market setup, how things are looking. The second is the 2,000 rupee impact. And the third is, of course, the global setup. So Nifty and the market setup first. Now, on Friday, we got a very nice bounce. From the lows of the day, we got a 100-point bounce off the Nifty's low. We touched the 20-day moving average, took support. Actually, intraday, we did break the 20-day moving average. But basically, you got a clean bounce off that and a very nice, decent close. And, since the 12th or so of May, which is over the last prior 1 week or so, the market has basically been coming off. All right, we got a higher close, but for the week, the Nifty was down 0.6%. So there was a bit of a congestion zone. And with this kind of a bounce, an important short-term reversal level, the question is whether we can move higher. Now, for that to happen, Friday's low becomes important. 18,060 should not be broken if we are to get a bounce which kind of sustains from here. The 20-day, of course, will come into reckoning again. But the low was under the 20-day, so I'm putting 18,060, the low as the critical point. The high on the Nifty at 18,459, this is the high which was made on the 15th of May, can be retested. I would say it's more bullish as compared to bearish. That's basically my thought process at this point in time. There are some sort of conditional aspects which we will get to in just a bit from now, but a test of an important sort of level and then a clean bounce. It's not looking bad. Now, the Bank Nifty support comes in as 43,466, and then at the 20-day moving average, which is 43,300. Now, the 43,466 is Wednesday's low, I think, and then the 20-day moving average. These are supports. Bank Nifty needs to break out of the congestion zone, and the congestion zone high is basically 44,150, which is also pretty much the all-time high. About 2 points or so higher than that is the all-time high. So this is how we would look at things. Now, coming to the 2,000 rupee note withdrawal, and there'll be lots of opinion which we will get to you, but announcement came Friday after market hours, Friday evening. Now, the important thing is, unlike the 2016 demonetization, the 2,000 rupee notes at this point are only about 11% of total currency in circulation. At that point, the total amount of money which was demonetized was almost 86-87% of the currency in circulation, so this is not that large. Which essentially also then means that, the impact, the near-term economic impact overall could be quite limited. That's the understanding. Now, some are saying that this is great news for banks because as people go and return the money and give it to banks, and banks in turn give it to the RBI, it swells deposits, brings down the cost of deposits for banks. It sort of takes care of the liquidity in the system, etc. But the point is that will depend on how much is going back and how much is being exchanged, which we don't know. People like Citi's India economists are saying that they expect only about 10 to 15% of these notes to actually be deposited. So the impact even on that, on the overall deposits in the system could be limited. But this is a point which we will come to a little later, but overall impact is limited. Now, global markets are the other third point. They are beginning to price in a 25 basis point hike in the month of June, in the next Fed meeting. US data is the number one reason. Retail solid sales, the initial jobless claims dropped, so things are not looking all that bad. The important sort of near-term mover, and this could be big, is the debt ceiling. Now, by all indication, there is no official date given for when the US Treasury runs out of money, but there are estimates, and best estimates converge around the 1st of June, which means that the markets will wait for some kind of a deal to be reached this week over the next 5 trading sessions. It always happens. It does go through. Sometimes it's last minute, sometimes it's a few days before, but so far we've had scares, but never has the Treasury defaulted. So markets are assuming that it'll get done this week, and I think, but markets will wait. I mean, it's not done till it's done, as they say, and I think once it's done, markets perhaps will see relief, and perhaps we see a bit of a risk on in global markets as well. So that's the only near-term kind of thing which global markets will hold on and watch at this point in time. Otherwise, I mean, the economy in the US is looking better as compared to what was perceived a month or 2 months back. SGX is up on your screen. It's indicating a 25-point lower start. Sonia.
Oh, absolutely. And, we're going to start on the back foot today, not just because the SGX Nifty is under pressure. Global markets have been under pressure. The Dow had, a big fall as well overnight on Friday. And even for our own markets, right? I mean, the Nifty closed lower by 1% last week and is facing resistance at the higher levels, 18,400, which was the high we hit on Monday, around 18,450. Since we hit that high, the market has just cooled off from there, so come off quite a bit. There is this negotiations on the debt ceiling talks which continue, and that has kept a lid on the global market gains. For our own markets, it's an important week because we have the F&O expiry this week, so all eyes will be on that. If you look at the global markets, there was, of course, pressure that we saw on Friday, but this is what the weekly performance has been. It was a pretty strong session that we saw. 3% higher for the Nasdaq, S&P 500 up 1.5%, and even, a lot of markets like Japan have been doing pretty well. So let's see how our own markets move forth. The one interesting thing is after 16 days of buying, finally we saw a sell figure from FII. So FII flows have cooled off a little bit. Perhaps because, resistance is kicking in also at higher levels. But this is the last leg of the earnings season. So let's see what we get in terms of takeaways from there. There are a lot of big numbers. There's Hindalco, M&M, Sun Pharma, Ashok Leyland all coming out with numbers this week. BPCL as well. So a lot of the interesting pockets report their earnings. And I just wanted to put one view that came in from Surendra Goyal of Citi this morning, where he has actually raised the Nifty target to 19,400 by March of 2024. And that's a 6% upside to Citi's earlier target. Now, the reason they state is that the Indian market valuations are now becoming reasonable compared to the last 5-year average. So it's just a valuation game that they're looking at. They say that FI flows have picked up. Domestic mutual fund flows are resilient. The market is likely to re-rate higher. So there continues to be a lot of bullish calls on the market, although we are facing a bit of a hurdle on the upside. Just one thing, on the 2,000 rupee note cleanup, I mean, from a viewer or an investor point of view, one thing, it continues to be legal tender. Yeah. And you can exchange up to 20,000 rupees at one time. It is, a free of cost exchange. So there is no need, I'm sure a lot of people know this, but there's no need to panic at all. It is very different from the demonetization situation that we had last time around. And it could ease short-term rates as well. So, in my understanding, I don't think it is such a big deal. But then, of course, experts may suggest otherwise.
No, you're absolutely right, Sonia. I mean, no need to panic, and I think we should say that unambiguously. Yeah. And the impact also seems to be much smaller because it's a smaller portion of the total currency in circulation. But Nigel, what are you watching on for?
Well, the FI net sell number, is it a change of trend or was it just a flash in the pan? We'll know today, right? And as you said, the dollar index is a little bit weaker, which is good. So hopefully that was just a flash in the pan. The Nifty buy zone, well, we have that 18,050 to around 18,100. And this RBI withdrawal of the 2,000 rupee note from circulation, well, it could be beneficial to banks and maybe some discretionary sectors as well, just in the near term. But I'll be interested to see what's the reaction in broader market stocks, particularly some small cap, mid and small caps, or some cash market stocks. So let's see how that goes. What do the FIs do? Well, they added some mild short positions. Short positioning now is at around 52%. On the index option side, they bought more puts than calls. So in case things go wrong, you have some cushion out there. But what's encouraging, what's telling you maybe that 18,000, 18,050 will still hold out. Remember, it's expiry week, is the way they're writing puts. So they still wrote more puts than calls. Giving a broad sense about the options data, the highest open interest is at around the 18,200 call. So at higher levels, you're expecting that level of around 18,250, 18,300 to be met with some resistance. As we've seen in the past, 18,300, well, that'll be a mark that the bears will be looking to defend. But the encouraging part is there's writing witness at around 18,000 put as well as the 18,100 put. So it brings us to the levels. What do we look out for? Friday is low. That becomes an important support out there. You have the 20 DMA as well. So that's why I said 18,050 to around 18,100 becomes important on the downside. The Nifty Bank. Well, Friday's low again becomes important out there, 43,500 approximately. From there, we saw a bit of a bounce. If you break that, then you're hoping that at least that 43,300 odd mark holds out, because that's the 20 DMA. But on the upside, the fresh 52-week high, can we get past that level? Positioning is such that we don't get past that. If we can trade above those levels, I'll tell you what, the Nifty Bank will lead the Nifty higher, and that could easily play out given that we have expiry week. SGX Nifty suggesting a bit of a pullback. The buy zone, though, is a little bit deeper, so let's see how this goes. But today, I'll have an eye out on the broader markets to see if there is some incremental selling that comes in, particularly on some of these cash market stocks.
Okay, well, before we start, let's just tell you what's lined up in the first half hour of the show. We will be getting you updates from the markets across the globe. James Sullivan of JP Morgan will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30 a.m., we'll do a fundamental stock analysis with our market expert, Prakash Diwan. So do stay tuned in for that. But first up, we have a couple of interesting views coming in on the market. So let's take a look at that. First up, we have a call from Sridhar Shivaram of Enam Holdings, who said, this is a sideways market, and they expect the market to be range bound and interest rates to be higher for longer. They do not expect the RBI to cut rates at least for the next 6 months, which according to Enam is not the best environment for equities. In terms of earnings, Sivaram expects Q3 and Q4 to be better for discretionary and consumption companies.
Okay, well, let's get you some money market views. On the rupee, B. Prasanna of ICICI Bank says better economic data prints, uncertainty over debt ceiling deal and hawkish commentary by Fed members kept dollar on strong footing along with rising yields. Weaker than expected data flow from China is putting pressure on the yuan and the entire Asian pack. Rupee, even though supported by good external balances and flows, fell on position squaring in offshore market owing to shrinking carry and stronger dollar against Asian currencies. In the near term, they expect rupee to trade between 82.4 to 83.2 to a dollar, with RBI selling dollars to protect sharp INR depreciation.
And on the bonds, B. Prasanna of ICICI Bank says global yields inched higher even as local bonds initially rallied on expectations of a very high dividend from the RBI. The actual dividend announcement on Friday fell short of expectations, and as a result, bonds gave away all the gains. Additionally, the RBI announcement of phasing out of 2,000 rupee currency notes is expected to result in an increase in the partial system liquidity over the next 3 to 4 months. This, coupled with large GSEC maturity, augurs well for the short end of the curve. He expects the 10-year benchmark to trade in a range of 6.9 to 7.05%.
Well, we have a lot of stock-specific action which we're tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at JSW Steel, NTPC, Power Grid Corporation, Muthoot Finance, Bandhan Bank, Bharat Electronics, Zomato. Their stocks on the back of positive news flow. While on the flip side, you have Divi's, Glenmark, Delhivery. Their stocks that could be reacting to negative news flow.
Okay, well, I just want to put out one more view. This is coming in from Goldman Sachs' economist, and this is a view coming in the U.S. Debt ceiling crisis. Now, they say, and I quote, the U.S. Treasury has indicated that it is likely to be unable to make payments by early June without an increase in the debt limit, with the risk that this should occur as soon as the 1st of June. Overall, most parts, they say, of financial markets appear relatively sanguine regarding the approaching debt limit deadline. While they expect a deal to occur ahead of the deadline, they also expect a few more twists along the way and suspect that markets are likely to price in additional risks before the debt limit is finally raised. But raised it will be, they say, in their base case. Let's actually put this to James Sullivan, Managing Director, Asia Pacific Equity Research at JP Morgan. James, good to have you with us here on CNBC-TV18. Appreciate your time. I just wanted your thoughts on this debt ceiling business, because twists and turns we've seen, but there's not very much time left now for more twists and turns if it is indeed 1st of June. Your own sense on how this is likely to pan out and what are implications for markets around the world?
Sure. Thanks very much for having me on the program. The first thing I would say is, from a timeline perspective, JP Morgan is estimating that the X date, the day on which the U.S. federal government will run out of enough money to pay its short-term bills, will be June 7th. The critical element to that is on June 1st, you have an $80 billion payment for Social Security and Medicare. So you'll be very, very tight after June 1st, but we are still looking for a couple of incremental days to try to work to a solution, which is important in terms of the overall shape of markets. I think the nerve-wracking thing here is what you've already highlighted earlier in the program, which is that markets are generally ignoring this. If you look at volatility, volatility is still sitting at the lows. The vol statistic is actually only pricing in roughly a 3% odds of recession. So there's very little fear built into markets at this stage, which is one of the reasons why we're arguing investors should look to this opportunity to raise cash and come in on the back of any volatility and turmoil that we might see in markets.
Okay. James, hi. How are you feeling about the Indian market now? Because, you know, it has a special place in global markets as we speak, considering that valuations are looking much more reasonable compared to what we saw last year. Growth is picking up. GDP expected to be, 6.5% plus. At such a time when both the valuation and the growth argument are working in favor of India, has the time come to raise your allocation as a global equity, observer towards a market like India?
It's a great question, and there's really three things that I would focus on as an answer. Number one, it is important to recognize that you've seen significant fund flow largely out of China and into India on a year-to-date basis. The average institutional investor right now is already overweight India, so there is a marginal incremental buyer conversation to be had, would be point number one. Point number two, as you rightly say, expectations are not that low right now, particularly as it relates to earnings growth. Street estimates for this year and next are looking to 18 and 15% EPS growth for the overall Indian market. JP Morgan estimates put that somewhere closer to 11 to 13%. So we are looking at the potential for downside as we go into the next 6 to 12 months. The third thing that I would note from a macroeconomic perspective is that foreign direct investment into India has dramatically slowed year to date. And this is something I don't believe we're talking about enough. It's more than halved as a percent of GDP, which is somewhat startling given the opportunities with China Plus One and supply chain relocation, as we've discussed in prior programs. So if you put that together, I still think there are very clear things that we need to be paying attention to in the Indian market. The one sector where we do see an asymmetry of risk, as you've already stated earlier in the program, is really the banking sector. Earnings have already been cut extremely aggressively, and we think we've formed a baseline for outperformance going forward.
All right. Hi, James. Good morning. Over the weekend, I was reading a couple of articles, and after a while, I'm hearing about not a pause, but there's an outside chance of another rate hike from the U.S. Fed. Do you think there's an outside chance, going by the inflation data and the unemployment data as well? They seem to still give that outside chance a bigger chance. Your take.
So massive volatility in the conversation. JP Morgan's view for some time now has been that we will be on a pause for an extended period of time. If you look back 2 weeks ago, markets were pricing in 100 basis point of rate cuts by the first quarter of next year. On Friday, you're absolutely correct. You saw a movement from a 0% odds of a rate hike to a 35% odds of a rate hike. That's now normalized back to about 20%. But again, volatility is the watchword there. The macroeconomic statistics are somewhat confusing. Our base case, however, is that the global all-industry PMI is still looking for global growth of about 3.3%. You are seeing some signs of disinflation, particularly in emerging markets, but we do think the U.S. economy is, in general, holding up significantly better than where people had been thinking earlier this year.
James, you said that your advice, JP Morgan's advice to investors is to raise cash. That is, the impact of this debt ceiling thing is largely limited to the U.S., or you think this could percolate to other markets as well? And you are, if you're asking investors to raise cash, that means that you are expecting some volatility and some big moves, which should give the opportunity for people to get in when that happens. Go on.
Again, great question. The only volatility that we've seen so far has largely been to the upside. As you posted on an earlier graphic, U.S. markets were up last week, which is slightly contradictory going into the debt limit ceiling as early as the end of next week. And so we don't think that there is really any level of fear baked into particularly U.S. and European markets. We are underweight both the U.S. and Europe from an equity perspective, overweight emerging markets. And so to your point, I don't think you'll see significant contagion into EM. But we do have to reflect on the fact that U.S. Treasuries are still a key cost of funding for many large multinationals around the world. So if you see funding costs go up, the potential for investment reductions to occur could create an incremental drag on global growth.
James, if there is an issue, yields will fall, right? Or will they rise? They should fall, I'm assuming.
So it's a great question, because one of the odd things about the centrality of the U.S. market to the global economy, in a flight to safety, you sometimes see effectively safety buying of U.S. Treasuries, despite the fact that the U.S. Treasury is exactly where the risk sits And so you get this odd dynamic in global markets. From an equity market perspective, however, we do think that you're likely to see the risk-free rate of return go up, the perception of risk go up, and therefore markets likely trend down. The critical thing that we would focus on, particularly in the U.S. market, is the very narrow breadth of market outperformance on a year-to-date basis. You've effectively had 6 to 8 stocks leading almost the entirety of U.S. equity market performance. And so that narrowness of performance is interesting. We do see the potential for a rotational trade out of those top 6 to 8, which are largely the mega cap tech stocks, and into the broader economy on the strength of that economy over the medium term.
Okay, James, we will let you go on that note. Thanks a lot for joining in and speaking to CNBC-TV18. That's JP Morgan with their view on the global markets and also how to approach a market like India. Let's slip into a quick break. It is the fag end of the earnings season, the last leg, so to speak. Lots of stocks in focus when we come back on the other side. Also, the SGX Nifty indicating a slightly weakish start, so do stay tuned in for more on Bazaar Morning Call.
What does your investment portfolio look like without gold? Incomplete. Because as a gold owner, you have the power to make bold decisions. To balance risks and returns. The power to buy and sell, right at your fingertips. Making gold your strategic advantage.
Without which your portfolio is incomplete.
Power your portfolio with gold. World Gold Council.
Yes, it's okay for us to nod for everything. Because we are parrots. Yes, but your wealth manager? Shouldn't be doing that. You know?
Choose Nuvama. We only do what's right for you and your money. Nuvama. Let's do it right. Z Black Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
Welcome back. This morning, the SGX Nifty is indicating a start in the red, but that's also because global markets have been slightly under pressure on Friday. Most markets, the US markets closed in the red. Also, you had FI selling in the cash market after 16 days of buying. So markets have cooled off a little bit, but plenty of stocks to talk about. So let's get straight to that. JSW Steel is the first one that we're looking at this morning. Nigel, why are you watching that?
Well, the numbers looked very, very good, actually, Sonia. Much better than what our poll drops. On the top line, the EBITDA as well as the profitability, the numbers were much better. What are the key reasons? The standalone business, that's the India operations. Out there, you had the EBITDA per ton came in closer to around 11,000 rupees per ton. That compares with an estimate of early 10,000 odd. So that was a beat. But the bigger beat came in from their subsidiaries. And if you're just looking at it, Bhushan Power and Steel, JSW steel coated products, take a look at the swing on a sequential basis. Big improvement out there. On their US operations, Baytown, well, good EBITDA number out there. And on their Ohio facility, well, the losses have come down. Not just that, on the European business as well, the EBITDA per quarter now has moved to more than 10 to around $15 million, and they expect that to sustain. So good news out there. Net debt as well came down because they've released some working capital as they had promised in the previous quarter. The only risk, though, is that steel prices continue to remain soft, and coking coal cost will be higher in the first quarter in comparison to last quarter. So there'll be some bit of a pullback in terms of EBITDA per ton, expecting it to open up in the green. And remember, you can catch the management of JSW Steel at around 9:30 a.m. today on Bazaar itself. Mr. Jayant Acharya will be joining in.
Okay, well, that's the JSW Steel management coming up on the program. Well, NTPC is the next one in focus. Vivek has got details and numbers. Vivek, hi, morning.
Well, good morning. It's a slightly mixed set as far as NTPC is concerned. However, profits managed to beat our expectations. Now, very important development. Street was eagerly awaiting, what the management would say in terms of a stake sale as far as its renewable energy arm is concerned. So, what the management said in the conference call was that at this point of time, once again, they are looking at either an IPO or a stake sale. So, that is not off the table. However, the management missed its earlier guidance of consummating this particular sale by the end of FY23. Now, talking about the numbers itself, revenues up almost 20.5%, EBITDA up 3.7%, and profitability was flat on a year-on-year basis. Our profitability managed to beat our expectations. In terms of the guidance that the company has given, now what we are looking at is capacity addition in the thermal arm For FY24, 4.6 gigawatt is what the company is targeting. And, as far as the renewable energy capacity addition is concerned, it's a lot more aggressive. Between FY24 to FY26, they're targeting almost 16 gigawatt of addition. Expect some slight green on the stock on the back of the profit beat.
Okay, thanks a lot for that, Vivek. Let's find out what's happening with Divi's Laboratories. Post the numbers. Ekta is here to give us the lowdown. Ekta, good morning.
Thanks for that. Well, for Divi's Labs, I was completely torn in terms of what the stock reaction could be. So I'll just take you through the numbers first. The revenue was in fact better than expectations. The revenue was down 22.5%, came in at 1,950.8 crores. The street was anticipating around 1,863 crores. Margins came in at around 25%. The street was anticipating around 29%. Remember, there's a Q-on-Q recovery which has taken place in terms of margins for Divi's, and that's what the street was anticipating. But it's come in lower than what the street was working with. So 29% is what the street was working with, 25% is what they reported. Profit down 64% year on year, 321 crores. Estimates were 373 crores. But incrementally, the calls seemed to be positive. The company said, yes, there was no one-off which resulted in the margins declining in the first half of FY23, but they do expect gross margins to recover. They expect Q-on-Q, or they have seen Q-on-Q growth in their key segments such as custom synthesis as well as generic API. And the company has also said there are 2 custom synthesis projects which should come on stream in the next couple of quarters. So it seems as though there is some recovery which is taking place in the business, and that's the reason that I'm going with green. Elara has a sell with a target price of 1980, but Jefferies as well as HSBC both have upgraded Divi's. Jefferies all the way to buy from underperform, and HSBC to hold from reduce. So I'm assuming that the momentum could be on the upside today.
All right, Ekta, thanks very much for that. Divi's, as Ekta said, I mean, she's going with green, but as she herself said, we'll see. 3098 is the close on Friday. BEL and Power Grid are the other numbers. Going back to Vivek. Vivek, tell us more.
Well, that's right. So Bharat Electronics, at the end of 9 months of FY23, analysts were concerned about whether the management would be able to meet its guidance. But a very strong Q4 execution has actually ensured that the company has managed to meet all of the guidance that it had given for FY23. Now, talking about the numbers were a beat to as far as street estimates were concerned. Revenues higher by 2.5%. When you're talking about the EBITDA, up almost 16%. Margins coming in quite strong, over 350 basis points of expansion, and profitability higher by almost 20% on a year-on-year basis. The order book coming in very strong at over 60,690 crore. Implied order inflows thereby coming in closer to the 17,000 crore mark. Now, Nuvama actually has written on the results. What they're saying is that the margin expansion has come from a couple of factors. That is input cost cooling, ease in supply chain of critical components, as well as better product mix that the company enjoyed in Q4. Now, coming to Power Grid, the company delivered a strong set of numbers. It's a clean beat as far as our poll is concerned. Revenues higher by almost 15%, profitability higher by 4%. And when you're talking about the margins too coming in very strong at 89%. However, there was one setback. The consultancy business actually saw an EBIT loss this time around, and analysts, are waiting for some explanation from management when the analyst call happens today. Morgan Stanley says that, the profitability has actually beat expectations on the back of multiple one-off factors, including lower depreciation, lower income, as well as higher other income and lower tax rate. Interesting to see how, these stocks will perform today.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across back to Ekta to tell us about Glenmark Pharma. Ekta?
Thanks for that. Well, Glenmark, the numbers were largely in line with estimates. The revenue was up around 12%. Street was anticipating 11% growth. US sales were $104 million versus estimates of around $100 million. India was weak, but that was on account of a high base. Rest of the world was up 25%. Europe was up 22%. Margins 18% versus estimates of around 18.4%. But there was a loss this quarter on account of a one-off settlement with regards to Zetia generic, one of their key drugs. Also, the stock is close to a 52-week high, so we've seen a strong run-up for Glenmark. And what might deter the street is that the gross debt is higher this quarter on a Q-on-Q basis. It's coming at around 4,347 crores versus 3,670 crores on a year-on-year basis. So there could be some amount of negativity on account of that, as well as the fact that the numbers were largely in line. There was no real big positive surprise which came through. Call is at 9:30 a.m. All eyes will be on that.
Okay, Ekta, thanks a lot for that. Well, let's go across to Mangalam to find out how Zomato's numbers looked. Mangalam, a decent showing this time, and you're also tracking delivery?
That's correct. So for both Zomato as well as delivery, the underlying theme is operational improvement. However, that comes, of course, at the cost of growth as well. But better for Zomato than delivery. Let's start with Zomato. What's weak is basically the gross order value food business. The core business has seen a decline of about 1.5% quarter on quarter. Food revenues grew just by about 2% and monthly transacting customers also fell by 4.5%. The company attributes this to them moving out of geographies which weren't profitable for them. But for the entire year, their average order value as well grew just 2.2%. However, all of this meant better operational performance. The food EBIT margins at 7%, the highest ever. Blinkit revenue grew by about 21%. Blinkit losses also narrowed. In fact, the company said as of March 2023, 65% of the Blinkit orders came in from stores which were contribution positive. In fact, that's not all what the management said. They said that they are targeting positive adjusted EBITDA and net profit, including Blinkit, in the next 4 quarters. They will do that by reducing losses in Blinkit and increasing the profitability in the food business. So the street should like that, see some green on Zomato. As far as delivery is concerned, while the operational performance was positive, that came on the back of them reducing some costs like other expenses and freight costs as a percentage of sales as well. They've posted an EBITDA of 13.4 crores versus a loss of 73 crores the same time last quarter. The revenue growth has just been about 2%. And secondly, the company has gone ahead and made an acquisition, a small one, 25 crores for 10% stake in a SaaS player for omni-channel retailing. So let's see how that goes about.
All right, and we have the management of Delivery join us a little later to talk about that. Mangalam, thanks very much for that. More numbers coming through. So Bandhan reported earnings, Muthoot reported numbers. Abhishek is standing by with implications and the read-through. Abhishek.
Well, Prashant, to begin with Muthoot Finance, the gold loan momentum is back over there, seeing a sequential loan growth of 8.9% in the gold portfolio, which has aided the overall AUM growth to be around 9.5% quarter on quarter. The Belstar MFI, their gross NPA ratio has declined by 497 basis points, which is heartening to see. It's now down to 2.43% when compared to 7.4% in the previous quarter. The Home Finance, their AUM growth was weak despite the fact that disbursements growth was strong. Revenue and PAT over there also declined by YOY and quarter on quarter. So in overall, the net interest margin has expanded both YOY and quarter on quarter. Net interest income growth is about 7.7% YOY and about 8.7% sequentially. PAT growth is almost flat on a sequential basis and down about 6%. Bandhan Bank, they have given FY24 guidance as well. The loan growth is about 20% is what they expect, with MFI loan growth of about 17 to 18% and home loan growth of about 22 to 25%. They are targeting a CASA of 40% and net interest margin anywhere between 7 to 7.5%. Credit cost will be around 2% and ROA and ROE is targeted around 2.6, 2.8% for ROA and ROE of about 18 to 20%. Coming on to the Q4 results, the gross NPA ratio is down sharply to about 4.87% when compared to 7.15% in the previous quarter. Net interest margin has expanded on a sequential basis. Operating profits are down. However, lower provisions have ensured that they remain their profit growth quarter on quarter was strong. Back to you.
All right, thanks a lot, Abhishek, for that. Let's do a quick recap in case you missed out on any of them. Stocks with positive news flow today: JSW Steel, very good numbers; NTPC, Power Grid, Muthoot Finance, Bandhan Bank, Bharat Electronics, stellar set of numbers this time; Zomato and Divi's Labs. While stocks with negative news flow, there's Glenmark Pharma and Delivery. But the big headline that came through post-market hours on Friday, the RBI on Friday announced it wants to withdraw all 2,000 rupee notes and directed persons having these notes to exchange them or deposit them in their accounts as this cash comes back to the banking system. What may be the impact? Lata is here with the editor's take. Lata, there was so much hoo-ha. People were scrambling around to understand what this means. But we've had some time to study it. So what's your take?
Well, first of all, it's just a withdrawal of notes. It's not being cancelled as legal tender. So it's valid, though people will not accept it in shops. But you can exchange it without any identity card. The more important part is what is the impact for markets at this point in time in Bazaar. That's what we have to look at. Last time around, it was a lot of money when it was 1,000 and 500 rupee notes. It was some 15 lakh crore that was pulled out. This time, it is 3.62 lakh crore of 2,000 rupee notes. Now, what is the calculation? Even if half of that comes and stays, then there is going to be a lot of improvement. Remember, many people will exchange. So let us assume half comes, then the system liquidity can improve. But economists are extremely divided. There are estimates as low as 10% only will stay back because people will put it out. And there are estimates as high as 50% also. But it's quite possible that closer to 50% stays for some time. Now, what impact does it have? Immediately, short-term rates will go down because the market was in a tight liquidity spot. There were other things that happened. The Reserve Bank did a VRR, what you call a variable rate repo, whereby it puts in 50,000 crore for 14 days. And there was a bond redemption as well of 66,000 crore. So all told, you're going to see one-day money to short-term money, one-year T-bills, all of them yields falling. Now, whether it will reach the final yield curve is a little unlikely because the Reserve Bank dividend of 87,000 crore turned out to be a disappointment. The market was expecting, over 1 lakh crore. So maybe the entire yield curve is not going to benefit much. It's not as if the government is going to borrow less. Now, banks, I think the impact would be interesting. The chances are that even if this money stays for a couple of quarters, say, then at least for 2 quarters, banks don't have to raise deposit rates. So whereas everyone said Q4 is net margins have peaked, now you'll perhaps extend that same margin calculation to this quarter as well. So there could be a positive for bank stocks. Let's see how things pan out on the CRR front. A CRR cut was expected second half of the year. That may now get pushed.
All right, Lata, thanks a lot for that. An important story, an evolving story, but at the end of the day, we all know it's still legal tender, so there's absolutely no need to panic for that.
There's one more thing that people are talking about. I thought the equity analysts will talk about it. If people have a lot of money and they don't want to give it back, they may end up buying gold or consumer durables. So there is a bit of an expectation that gold jewelry sales may go up.
Absolutely. I think our commodities editor Manisha Gupta is going to take that forward with greater detail later on. So do stay tuned in for that. But thanks, Lata, for joining in. Let's get our first corporate on board now. Delhivery posted a mixed set of numbers, as you heard Mangalam just point out a while back. The growth was muted, but it's the operational performance that has improved on a quarter-on-quarter level. Sandeep Barasia, the Executive Director and Chief Business Officer at Delhivery, is joining us now to help us understand the business as well as the way forward. Sandeep, great having you on CNBC TV18. Thank you for joining in. There is this term that I guess is overused by now in your space, path to profitability, right? Just tell us a little bit about that. Put down some numbers for our viewers and for your shareholders. What is the long-term target in terms of the EBITDA margins? In Q4 of this year, you managed to do about 0.3%. But by the end of FY24, what could the margin performance be?
Hi, Sonia. That's a great question. And I think, as you rightly said, that we did do 0.3% positive at the end of Q4. And I just want to remind people that at the end of Q1, we were minus 12.5%. And we've turned that around to positive 0.3% in Q4. From an EBITDA basis, we are pretty much break even. And the growth momentum continues. And the incremental margin that we're experiencing as a business continues to be very, very high. So we don't see any reason for that trend to actually not continue in the near future. So I'm not going to point out an exact target or an exact date when we will actually, what we will hit when. But there's no reason for us to believe that the last 4 quarters are not going to continue to the future. And that's the objective. Ultimately, the objective of the business has to be to deliver positive cash flow for shareholders. Getting to EBITDA positive was the first step. Growth is continuing. Incremental margins are continuing to be very, very strong.
Sure.
And so I think that trajectory should continue going forward.
So what are the margin levers that you have at the moment? Are you looking to bring down costs in a certain way? If yes, what would they look like over the next, say, couple of quarters? And when you say growth momentum will continue, what kind of margins are you targeting? I mean, are you looking at low single digit for the first few years? At some point, are you looking to get a double digit just to get a sense of how things are headed from here?
See, again, I don't want to get specific in terms of margin targets. Sure. Both, two of the largest business, Express Parcel and Part Truckload, very similar businesses. They're quite complicated in terms of being able to execute on the market. And there are global benchmarks of companies that actually make very high margins in this business. There's no reason why India should be any different. So eventually we should get to considerably higher margins from where we are right now. The levers that we have, they're cost levers and growth levers, right? In terms of cost levers, through the last 4 quarters, we've become extremely efficient as a business. And that was always going to be. That was the logic behind we did the M&A. That's the logic behind how we've sort of grown as a company. This is a scale-driven business. As we continue to get larger and the scale efficiencies come in, our cost structures will actually continue to improve. I'll give you one example, is the introduction of the 46-feet tractor trailers that we run in our network. Now, we've been able to roll them out much faster than we thought we will roll them out. And as we keep rolling them out, we are seeing that there's still a lot more headroom for us to roll out those tractors, even to smaller towns like Kanpur and Bhopal. It's not something that's just restricted to Bombay, Delhi, Bangalore. And as the network continues to expand and the rollout of the tractor trailers continues to grow, we are seeing that there's still a lot more efficiency that we can gain as a business. So there's definitely cost to have.
Okay, all right.
Sorry.
Hi, Sandeep. Good morning. Sandeep, you mentioned considerably high margins is where you're headed. Could you quantify what that could be with a time frame, maybe in the next 12 months, next 24 months? What could that range be, considerably high margins? And also, in the last 4 years or so, you've grown at roughly around 45%. CAGR, I'm looking, 4-year CAGR. You continue to maintain that sort of momentum going ahead?
So obviously this year, FY23, the growth was muted. But what we have seen, Nigel, is that we've been gaining share on Express Parcel. I think in the long term, we are very positive about e-commerce growth in India. We do think it will continue to grow at 25-30% over the longer term. In the shorter term, that can be different. You'll have cycles up and down. We've been gaining share in Express Parcel. So I think that we're very positive about where Express Parcel is going to grow. On part truckload, firstly, overall part truckload grows faster than GDP plus. The organized segment grows even faster. And then once again, we've actually massively grown in the last couple of quarters over there, 23% growth just in last quarter. So we are very bullish of both e-commerce as well as part truckload in terms of growth going forward. I can tell you that April for part truckload was stronger than January, which is significantly a much higher quarter. And May so far has been stronger than February. So the growth momentum is there. Now, what I mean by margins is I don't want to get to the specific number on margins. If you just see what we've done in the last 4 quarters, that has gone from minus 12.5% to plus 0.3, right? So that's almost a 13% shift in just 4 quarters. So, that we've got to try to continue pushing that forward.
Sandeep, hi, good morning. Prashant here. Yields are lower, right? Yields have come off. So both for the part truckload and the express parcel business as well. And that's even as volumes have grown. Actually, volumes for the part truckload business have also, revenues have seen a fall year-on-year basis. But just to focus on yields for a bit, could you give us some sort of way to think about this? What will happen here for both businesses?
Yeah. Hi, Prashant. That's a good question. See, I think it's very important for people it's great that you asked this question. I think it's important for people to understand that yield is a factor of mix. And so quarter on quarter, mix can change, right? Parcels can be smaller, lighter, they can travel less distance. And the change in yield is really a factor of that. In Express Parcel, Q3 traditionally is a quarter where people tend to buy a lot of white goods, tend to buy a lot of heavier items. And so Q3 will always have higher yield than Q4. And similarly in part truckload, it's generally just a factor of mix change, no material change in pricing or any of that stuff. In fact, I think in part truckload, the whole industry has not driven any pricing change. So these are just purely mix changes. And actually, I think you made a very important point that despite yield coming down, we've actually expanded margins. So yield by per se doesn't have an impact on the margins of the business. When yield is coming down, it's because the parcels are getting smaller or distances are being traveled are less. So cost also is coming down in the same proportion. So yield per se doesn't matter. It's actually a combination of what yield and cost together that actually really matters to us. So it's just a pure cyclical thing, pure cycle, a mix issue, rather than a genuine pricing change in anywhere in the business.
Okay, all right. We actually have many more questions for you, but I guess we will leave it for another day. Sandeep, always a pleasure speaking to you. Thanks a lot for joining us and all the best. It's been a challenging last couple of years for the e-commerce business. I'm sure things are getting better now. So that's Delhivery. Very positive statements coming through. They're expecting a 25 to 30% growth, long-term growth in the e-commerce space in India, and they expect their margins to be considerably higher from here. Let's slip into a quick break. We'll in fact pose all of these questions to Prakash Diwan, who joins in for some fundamental stock analysis. Anuj will also be with us for a quick trade setup in just a bit. Stay tuned.
Yeah, Ajay, look at your dad. Will we be the same at his age?
Absolutely yes, if we plan our future like him.
How?
My father had invested in LIC's Jeevan Akshay, which gives immediate and guaranteed annuity at regular intervals, that too for life.
Wow. But do we have to wait until his age?
Absolutely not. We recently invested in LIC's new Jeevan Shanti, which gives deferred annuity, which means regular income after some years.
I see.
LIC.
LIC's annuity plans give 10 annuity options and flexibility in receiving regular income. LIC, हर पल आपके साथ.
We don't just create new standards. We create new priorities for the Indian car buyer. In fact, we make the whole world of India's mobility new forever.
एक ऐसी धरती जिसकी सुंदरता की कोई सीमा नहीं, कला, संस्कृति और ऐतिहासिक धरोहर का एक संगम स्थल प्रशंसकों को एक जादुई क्षेत्र में ले जाता है। जम्मू कश्मीर में एक नए युग की शुरुआत।
हमें मिलकर जम्मू कश्मीर को नई ऊंचाई पर ले जाना है।
श्रीनगर G20 प्रतिनिधि मंडल को जम्मू और कश्मीर की सुंदरता और मेहमान नवाजी का अनुभव करने के लिए स्वागत करता है।
Welcome back. Hope you're having a good morning. For starters, SGX is suggesting a mild pullback. In fact, now it's cut those losses as well. But Anuj joins us in the studio. Anuj, expiry week, how are you reading it and how do you approach trade today?
Morning, Nigel, Sonia, Prashant. Well, new week and new hope, obviously. Friday's close was very good, which I think raises hopes that things are looking good once again. On Friday, what we did was right on dot, the Nifty bounced back from the 20-day exponential moving average. Now, the first test of 20-day MA is normally supported. It's the second test which is more important. So let's see if at some point the Nifty revisits that 18,050 zone. So for all positional trades, that's your stop loss. And of course, this week will be all about the US debt ceiling, expiry week as well. And this is a monthly expiry. So that's why it's going to be very important. On the Nifty, I think this is a week in which you need to approach it based on levels. First support is 18,125 to 18,150. And the biggest support which the Nifty held again on Friday as well, 18,050 to 18,100. So, I mean, you try to buy it in those support zones. And as I said, 18,050 remains your sacrosanct sort of line in sand. At higher levels, 18,275 to 325 is when you run into first resistance. And the biggest resistance has been 18,450. The Nifty has slipped twice from that zone. Once at 18,458 and second time at 18,444. So that's why that level is important. On the Bank Nifty, it's going to be interesting because, again, the Bank Nifty has been making higher lows and has been defending some crucial support zones. The all-important support zone of 43,450 to 43,500. Even on Friday, the Bank Nifty bounced right from 43,500. The resistance is 44,000, 44,150. And, of course, 44,152 is where the all-time high is placed in. And the next 100 point, I think, is going to be crucial. And if the Bank Nifty faces rejection there, my sense is you will see some selling. But if you somehow take out 44,250, then I think it's going to be a lot of momentum as well. So let's see which way things move.
Okay, all right. Anuj, well, that's the important mark. And the Nifty Bank is going to be the one that will swing things around 44,150 to 44,250. Anuj just pointed out that level as a bit of a resistance. But Prakash Divana has been waiting by. Hi, Prakash. Good morning. Thanks so much, Prakash. It's a power-packed morning. Management's coming in there, news flow as well. But thank you so much for waiting by. Let's focus on a couple of stocks, Prakash. We had the management of Zomato. I'm sure you heard that conversation. What's your view on this stock? They're talking about gaining market share, good growth, and they have some ambition on the margin front, though they didn't quantify that. Your view?
Good morning, Nigel. So, yeah, I think for most of these so-called new age businesses that have raised money at expensive valuations, there's a lot of explanation that needs to be done. And it was evident with the Zomato, with Delhivery as well. This so-called path to profits is the long haul. And especially, when they're talking about the Blinkit business also kind of starting to look promising, there's a long way to go because of the competitive intensity that exists.
Prakash,
and, my sense is...
Prakash, you read me out there. We were talking about delivery. Unfortunately, I mentioned Zomato. So, yeah, you are answering the right question. We wanted to discuss delivery itself. Go ahead.
Yeah, okay. Yeah, because I was also wondering, but I did miss out on the Zomato.
No, it was a mistake on my end.
No worries. I mean, they to be honest, they are probably in the same boat. All of them have to explain so much, and then I could sense that restlessness from the management to try and convince all of us that the margin profile is going to be relatively better. But I see what's actually happening is that most of these businesses are also likely to face a lot of competitive intensity going forward. And, I had coincidentally last week spent some time in Calcutta talking to another similar express parcel, service provider. And the full logic is it's getting very regionalized, okay? Given the advantages that some of these larger regional players can offer and the fact that they're organically growing very well, it's not going to be so easy for a pan-India play like Delhivery to be able to do what they have set out to do very easily. And interestingly, the entire e-commerce business, while the metrics look very positive, there's much more of subsets within that, where if you miss out on some of the juicier parts, and Prashant was pushing on the margin question and the yield question, that's exactly where profits are going to become much more difficult to come. So I would wait. I love the business model. I love the kind of dominant position that they have. But it's all good at a price. At the current price, probably you might not necessarily get rewarded. Of course, the current price is also an outcome of the kind of exits that some of these PE investors have made in the past. So Delhivery will have to kind of make sure they don't make two mistakes. One is, what do they do with the 5,500 crore kind of cash that they sit on? And then they don't make any unforced errors in that. And the second is, the business environment needs to get profitable for most of these players. And as I said, the competitive intensity makes it much more difficult. So I would be patient. I would really want to wait and watch before they turn profitable in a significant way. And it's irreversible. The seasonality and all of that, you need to kind of look into a bit much more closely. And once they turn profitable is when you'd start kind of according some future values, which could probably, aid the price support. Right now, I don't think that's available at 360, 370 where it trades. So give it some time. Give it some time for sure.
Sure. That's on Delhivery. But, on Zomato, I mean, of course, we keep talking about Zomato because it's listed. But the entire space seems to be returning to profitability. Swiggy as well reported its food delivery business turning profitable, X of ESOP costs. And, Instamart, which is Swiggy's quick e-commerce business, has also become contribution margin neutral, or expected to become contribution margin neutral in the next couple of weeks. All right, let's do one thing. Let's take a quick break on that. But on the other side, Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades. And we'll continue talking about stocks, so do stay with us.
Is your strategy ambitious enough to drive transformation at scale? How can you design and deliver a strategy fit for the real world? Are you reframing your future, or is the future reframing you? Realize your transformation with connected strategy, transactions, and technology. Reframe your future with EY.
I'm slow. I'm a tortoise. But your wealth managers, they shouldn't be as slow,
Choose Nuvama. We move at the right pace because we only do what's right for you and your money. Nuvama. Let's do it right.
CNG car, there's no chance of storage.
If you get a CNG car, you've got to get a carrier.
CNG is good, but to get something, you have to give up something.
OMG! It's CNG! Big boot, big appeal, big reaction. OMG! It's the Altroz iCNG.
ये स्नैक्स एंजॉय करने का नया तरीका है, स्मार्ट तरीका है। पर आपको पता है और क्या स्मार्ट है? इन्वेस्टिंग ऑन एंजल वन, जीरो ब्रोकरेज एंड फुल कन्वीनियंस। अब तो मैं सिर्फ फूड शेयर करता हूँ, ब्रोकरेज नहीं।
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.
Okay, welcome back. Let's have the SGX Nifty up on your screen. 22 points lower, so it's absolutely flat. There's 7 minutes to go for the pre-open session. Let's get technical views in. Sudarshan Sukhani is with us, and so is Mitesh Thakkar, with their perspective on things in terms of how we start a fresh new week. Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. How are things looking? We got a test of the 20-day on Friday, and then a very nice 100-point bounce. So will we start with that kind of optimism and sentiment, or you think it'll be put to test once again? Your thoughts?
Morning, Prashant. My sense is that I think the corrective movement or consolidation which I was talking about, I think was completed on Friday, getting a low of around 18,050, which is also the 20-day exponential average. So I think that low is being made. In case you get a 20, 30, 40 point kind of a decline, it might be wise to buy into it with a stop below Friday's low. And on the upside, since I expect the market still to be range bound, I think around 18,250 is the minor pivot level, but broadly 18,450, which was the hourly high in the recent rally, I think is what I'm looking at as the target area. So try to buy closer to about 18,100 and keep a stop below 18,050. And on the upside, take some profits around 18,250, and then beyond that, 18,450. I think that's where the traders should look to exit long positions. Next few days, next 7-8 sessions, I believe that this will be more of a consolidative kind of a range-bound market.
All right, Sudarshan Sukhani is also with us. Sudarshan, hi, good morning. Do you also believe that this is a range-bound market? There's really no big trigger to take the market out of that, above that 18,400 level. And if that is the case, then what should the approach be today?
Yeah, good morning, Sonia. Well, it is a range-bound market. That now becomes clear, but it's not just range-bound. My own sense is that it is possible that we may be slowly entering into a correction of some kind. Now, correction is not such a terrible thing. It just says that the markets are overheated and they want to cool down and seek slightly lower levels. So I'm not a buyer today. Even if it is range-bound, the chances that the markets could dip below 18,000 are very strong. So the best trade is to step away from the Nifty and keep, focus on the Bank Nifty, where there is still a possibility of some kind of a rally with a stop at 43,500. But the Nifty is a complete avoid. It is possible that we may be eventually looking at lower levels in the Nifty.
Okay. All right. Hi, Sudarshan. Good morning. What about individual stocks?
Well, individual stocks have that same message. In fact, on Friday, market breadth worsened considerably. The Nifty rallied because heavyweights can do their own thing. Heavyweights can go in one direction, while most of the market sometimes goes in the other direction. So as I told you on Friday, a lot of stocks said the short-term trend is over. Balkrishna Industries was one of them. It's an intraday short with a stop above 22.30. Tata Motors, fortunately, is still an outperformer. Consider buying it with a stop under 604. GNFC had a big down day 2 days ago. That decline should continue. It's an intraday short with a stop above 602. And Adani Enterprises is in a trading range, but it's suggesting that some kind of an up move may be coming. So it's a buy with a stop under 1872. So it's a mixed bag.
And Mitesh, how about you? What would be the stocks on your list today?
Yeah, so I also have a mix of buys and sells, but slightly more biased towards the long side. X-side is something which I like a lot. It's gone into an intermediate uptrend. Last 2 days were corrective. So now is a good time to buy with a stop at 200 for targets of 212 to about 214. L&T Finance is a buy with a stop at 97 for targets of 105. And Bharti Airtel is the third call. That's a buy with a stop just below 795 for targets of around 825. One sell call, that's Dabur. Keep a stop at 525 plus levels, and 505, 504 should be the target area.
All right, thanks a lot for that. Let's slip into a quick break. On the other side of the break, we have the pre-opening rates kicking in. We'll also try and connect with Jasbir Singh, the Chairman and Chief Executive Officer at Amber Enterprises, to discuss their Q4 numbers and the way forward for the business. A lot of traction on that stock last week. More on that coming up in a bit.